That's a good-looking dollar you've got there. Be a shame if anything were to happen to it. Thank you. Let me ask you, what would you say if I told you that I could lock that up for you, nice and safe and sound, that I could provide you with convenient access to it at a series of widely located, automated telling machines, and that you could direct it to a particular recipient simply by using a handwritten note?
Ooh, that is appealing.
Safe, available, and convenient.
Very.
For that suite of services, how much would you pay?
$1?
No, that's not the answer.
Look, that's as high as I go.
Sir, I'm taking your money.
Thank you.
Here's a golden rule for you. Whenever anybody takes money from you, you should demand payment for it.
Well, duh, that's why I demanded those sweet services.
Chump change, chump services. No, you should have asked for money.
Someone's gonna buy my money from me for money?
They're going to rent your money from you for money.
Who's gonna do that?
Almost every bank in the world pays interest.
Whoa, even Goldman Sachs.
Actually, they don't do retail.
Been thinking. With these banks of yours,
Yes?
where's the money for all the money coming from?
Very good question. You bring us to the center of the banking concept.
That's just the concept where I wanted to bring us to the center of it.
The money for your money comes from money that other people pay the bank for money.
What was the bit about money?
Let me ask you a different question. If you needed $1 or more, where would you get it?
I'd earn it.
What if you need more than you earn?
Ask my mom.
What if you need more than she earns?
What am I doing with all this money?
Getting a degree, opening a business, buying a house?
I'd pay by check. Anyway, I'm kind of tied up on other projects right now.
We're pretending.
A bank.
And what will you give this lender of yours for the money you borrow?
I'll gladly pay it all back on Tuesday.
Not good enough.
So much greed.
Some people don't repay their loans. We call this credit risk.
Hey, I'm totally gonna get that pen back to you.
And while you're borrowing the money, the owner can't use it. We call this opportunity cost.
Okay, I'll pay you.
You'll pay the lender, and thus we have a bank. Banks charge more to lend their money out than they do pay out to depositors for leaving their money with the bank. And banks make money on the spread between those interest rates. Let's consider a historical example. A generally good idea for a business is to take stuff from where it's cheap and abundant and to bring it and sell it where it's rare and highly valued. So bringing coal to Newcastle, bad idea. But bringing flavor to English cooking, good idea. But buying a boatload of spices requires money for both the boat and the spices. If you happen to be very skilled at sailing or knowing where spices are, you might still need the money. On the other hand, if you've got plenty of money and you want to try and increase that money, you may not happen to know anything about sailing boats or spicing. If those two groups can come together, fantastic. Banks serve as full-time matchmakers. Generally speaking, the lenders are going to demand a high interest rate because they're afraid they'll lose all their money. And of course, borrowers are going to demand a low interest rate because they're the one doing all the work and taking all the risk. And that great squabble is part of the negotiation that goes into banking.
So banks just charge as much as they can to lenders and as little as they can to depositors.
Yeah.
Then forget the spice racket, bro. Banking is the business for me.
Banks have been known to fail.
No way! What could go wrong?
Borrowers might not repay their loans.
Sure, credit risk. I got a solution for that.
Oh?
I'll just charge more for all my loans to offset the ones that fail.
Then won't borrowers go to a cheaper bank?
I'll just pay less to all my depositors to increase my spread.
Then won't depositors go to a better paying bank?
All right, then I'll just go back to trading spices.
Why not address the lending risks using other tools?
Like what?
Capital reserves, credit scores, collateral, insurance.
Exactly.
What would happen if a bank lent out all of its deposits and they all defaulted?
I'd get blamed?
The bank's depositors would get nothing.
Well, plus the interest on nothing.
So how would you protect against this?
Don't allow defaults?
Can't be done.
Don't allow banks to lend?
Don't allow banks to lend all their deposits. If they're required to keep a certain percentage on reserve, they can still meet the daily requests from depositors while protecting the risks from their loans. A 10% capital reserve is common in this country.
Nicely played. But what about those defaulters, those jokers?
Yes, let's look at them. Is everybody equally likely to repay a loan?
Exactly equally likely? There are no ties in nature, my friend.
So why not avoid giving loans to the riskiest people?
That's blatant riskism.
True.
And how would I know who they are anyway?
Look for people who have defaulted before, or who don't have a job, or have borrowed more than they can repay.
Whoa, that's a lot of looking, mister.
Then just have somebody else boil it down to a simple score for you. A credit score?
Oh.
Or ask your lenders to pledge something of equal value to you if they can't repay the loan.
Never heard of it.
Collateral.
Lipitor?
Pawn shops, mortgages, auto repos, they're all collateral arrangements to protect loans.
Messy, but quality television.
Or how about the oldest trick in the book to protect yourself against risk?
Airbags?
Insurance.
But I'm already charging the borrowers for the loan.
That's true, and a portion of the interest is a risk insurance premium, but I was talking about the other side of the banking business.
The golfing?
No, the depositing. You can attract more depositors for a lower interest rate if you promise them some sort of protection that they'll get their money back.
Seatbelts?
Deposit insurance. Charge every depositor an extra little bit that you can use to buy deposit insurance.
But that's going to be less than their total deposit, so how can it make them whole?
It can't by itself.
And if I can't repay them, how can I be the one to repay the insurance?
You probably can't, so find someone else.
An insurance company? Another bank?
Sort of. In this country, a federal agency provides deposit insurance.
Wait, the United States government is in banking and insurance?
If you take away the military, that's almost everything the federal government does.
Word.